Hey guys, I hope I'm audible. Just post in the chat in case you guys can't hear me. Sorry, I started a little bit late. All right, cool. You guys can hear me. Started a little late because I had some, I was unable to start and record the Zoom session because of previous sessions which had filled up my Zoom space, the cloud storage. So I had to delete some old stuff and then start it again. Anyway, this is being recorded and the topic we want to cover today is first topic is put call parity, and the second one is realized volatility. So realized volatility is one of those two magic numbers that we are now aware drive our PNL in the long run, right? The first magic number was IV, implied volatility. We talked about that in the last session. And the second magic number and the relationship with implied volatility is what drives our PNL in the long run. The second magic number being realized volatility. So I was really thinking about how to explain realized volatility in a simple manner. But actually, let's look at let's actually start with in the last session. Let me just share my screen. Sorry. Okay, so in the last session, I had shown you guys an option chain. We were talking about implied volatility. Open up the strategy builder. Let's go to the option chain. Let's look at Nifty because I usually just look at Nifty. Let's look at Nifty, the Jan expiry. And you guys had made the observation, when we talked about implied volatility. Guys, just mute yourself, please. So you guys had made a couple of observations. Mute. So the first observation was that the IV for the call and the put of the same strike is the same. It's 15.6. There's only one IV for two options, the option being the call and the put, right? And I had the reason for that I had given was that in case the IV is different, then it leads to some potential arbitrage. Somebody asked what is arbitrage, and in a nutshell, arbitrage means riskless profit, right? So let's actually create that situation. Let's create that riskless profit. And the way we are going to create that riskless profit is through this relationship between calls and puts called the put call parity. So the put call parity is a very, very fundamental concept in option trading. In my training, it was one of the, when I was being trained as a market maker, it was one of the first things that I was told to internalize. And let's just do a quick Google search of put call parity first. Let's look at CME group. So CME group, the CME is a Chicago Mercantile Exchange, is an option one of the biggest option trading exchanges in the world. And they've given this, it's an interesting way of putting it over here, right? They've said there's a futures price minus the call price plus the put price minus the strike should equal to 0. They've given a formula. It's an arithmetic formula. There's only plus and minus here. And these are all the things that we can actually observe in the market. Right. So what these guys are saying is that the future price minus the call price plus the put price minus strike needs to be equal to 0. It's a pretty bizarre, if you've never seen this relationship before, it's a pretty bizarre relationship. Why should this be the case? You know, why is this always the case? I'm not going to go into the why, but what I am going to show you is this relationship in practice. The way I remember this relationship is that long call is the same as long put plus something else. So let me actually just show you. So this is my option chain for 30th Jan expiry for Nifty. And everybody knows this is what the payoff of a long call looks like, right? Simple payoff of a long call that, hey, once the stock price, my inflection point is the stock price equal to my strike price, which is 23,800. This is, if the stock closes at 23,800 expiry, at expiry, I lose 11,000 rupees, which is here. And then every 1 rupee above it, I make, for every 1 rupee increase in the stock price beyond 23,800, I make essentially the lot size in rupees, right? So for every 1 rupee move, I'm making 25 rupees here until I reach this guy, which is my break-even point. And after that, it's unlimited profit, right? So this is, everybody knows this is what the payoff of a call looks like. Now let me show you something interesting. This we know is what the payoff of a put looks like, right? But I can actually create a call option using a put option in the future. So what I'm going to do is I'm just going to buy this Jan future along with this put option, and boom. This is exactly the same as my call payoff, right? The payoff of the call and the payoff of this combination portfolio that I've just created, which is bought a put and then I've bought the corresponding future, and boom, it looks exactly like the call option. In fact, it is exactly equal to the call option. And this is the relationship that guides it. So what happens if I sell a call option now, guys? What will happen to my payoff if I sell a call option? Sell this exact call option. Zoom, 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 zoom. That's right. It should be 0, right? So what does 0 actually mean here, Om? It means it's going to be a flat line, no matter where. So what does the payoff graph actually represent? The payoff graph represents, on the x-axis is the underlying price, and on the y-axis is my PNL, right? So my PNL fluctuates as my stock price is increasing or decreasing, right? Here, because this looks like a call option, my PNL is increasing as the stock price increases and is decreasing as the stock price decreases, right? Now, this is the payoff of a call option. If I just sell a call option, sell the same call option here, boom, it's just a flat line. Okay? So it's a flat line. It says no matter where the stock goes, my PNL is just 491 rupees. And there's a reason why this is positive. It has to do with the fact that these both are LTPs. They're not the exact bid-ask prices at that split second when this snapshot was taken. These were LTPs. So, so there'll be like some difference in the IV of the call and the put, which is why this is showing up as plus 500 rupees. If I were to do this, and then instead of this, here it'll show minus 500 rupees, minus 500 rupees. So basically, when we talked about, why the IVs of the call and the put need to be exactly the same, let's actually do some cheating. Let's change the IVs over here. So right now, both are being priced nearby at a 14.2 IV. if they were both exactly priced at a 14.2 IV, then this would be zero. But it's not the case. There's some like slight difference, which is coming from the fact that, these are LTPs, which update every 1 minute. That's what we store in our database. And there could be like slight fluctuations in split second between the call and the put IV just because of demand supply, and the prices that got recorded have that sort of fluctuation. So let's actually, so here, what I've done is, guys, I've bought a call, I've sold a put, and I've sold a future. Let me just reverse that because उसमें पैसे आ रहे थे. So buy and then sell. Okay. So what I've done is I've sold the call, bought the put, and then bought the future. Essentially, this is called a synthetic. So in trading lingo, we call it a synthetic, where we've sold an actual call and then we've bought a synthetic call. Buying a synthetic call means buying a put in the future. So let's do this. Let's call this demo. We'll call this a forward test. ठीक है. And यहाँ पे अब हमने, we've taken this virtual trade. This virtual trade is saying that no matter where the price goes, no matter where the underlying goes, we are going to make this 500 rupees plus 500 rupees minus our expenses, right? So, and the IV of this trade is around 14.2. All right, guys. So let's open that Black-Scholes calculator. And let's do something interesting where we're like, hey, let's get the, let's say that instead of me selling this at 466.50, let's say I sold this at a lower price. Maybe let's actually do this. Let's actually make them equal first. Let's make the zero first. Okay, so let's say मेरा 500 रुपए का प्रॉफिट आ रहा है, 500 डिवाइडेड बाय 4 into 5, 20 rupees. Maybe I do 446. Let's go here. Let's edit this to 446. So this is something that we are allowed to do in forward test. Boom, right? My PNL now becomes, is there a save button here? What happens? Save changes. There it is. I should probably make this CTA more obvious. Let's do save changes here. Save ho gaya. So guys, this feature has not really been tested very much. I'm actually showing it to you, and I haven't tested it myself, but this is a bug. So here it's showing, basically the payoff graph hasn't really fixed itself much. So what we've done is I've actually said that, hey, the price at which I sold this, if I make it 20 rupees cheaper, then my PNL is now close to flat. It's like, you see the straight line here, it's 8 rupees, right? So I just don't want to create too much of a confusion. So, okay. So this is in theory the no arbitrage price. This is the no arbitrage price, which means that if I were to sell this at 446, buy this at 440 and buy the future at this price, this is no profit, no loss. It's showing me an 8 rupee loss, but you guys get the drift, right? And this is essentially the difference between the decimal difference in the IVs. So let's actually now make this IV different. Let's actually make it really, really different. So let's come here. Let's say instead of selling this at a 14.2 IV, which I did sell it at, I sold it at a 14.2 IV. Let's say I sold this at a 15 IV. And guys, remember, I bought, both of them have the same, somewhat same IV, right? So in these prices, based on these prices, 446, 440, I have the exact same IV. Now let's change this to a 15 IV. Let's say instead of selling this at a 14.2 IV, let's say I sold this at a 15 IV, but I bought this, this put option, I still bought at a 14.2 IV. So what does a call look like at a 15 IV? My strike is 23,800. My spot is, let's put the synthetic future here, which is 23,823. 3. My expiry is Jan 30th. These I can put as 0. And this is my 15 volatility. So 477.32. It's even higher than this, right? Obviously. Let's actually make it even more. Let's say sorted at 20 volatility. 632.49. It's a little high, but okay. 632.49 would illustrate the concept, right? So I come here and I update this price to 632.49. All बहुत महंगी बेच दी है मैंने. Let's save the changes and boom. So this is my riskless profit, right? I've sold this guy at a 20 vol. I've bought this guy at a 14.2 vol, and then I've bought the future to lock in my profit. And this is arbitrage essentially, right? And there is no such thing as free money in the world. If there is, it doesn't exist for us retail traders. This is the free money here is essentially captured by these HFTs that are capturing this. In case all of a sudden there's a huge, buy order that came in this 23,800 call, and somehow the price increased really by a large amount, these HFTs will sell this call, buy this put, buy this future to lock in this risk-free profit. And because these HFTs are competing with each other, them aggressively selling this will lead to a reduction in this price. Them aggressively buying this will lead to an increase in this price. And eventually this arbitrage will go away, right? Now it is risk-free profit, but it's not really risk-free profit because these HFTs have done a lot of investment in technology infrastructure to be able to recognize this in the order of magnitude of nanoseconds and then capture this, right? So what happens, another risk that they have is what happens, let's say they sell this, but then this price increases so much that they're not able to buy this on time. So technically they have to lock in all three of these components to lock in their risk-free profit, right? And then this profit exists because of this relationship, which is called the put-call parity. If you guys want to know why this exists, that's a much deeper question. It exists because of the law of one price. No arbitrage pricing implies. It's not something that you need to understand why it exists. But what you need to understand is that it does exist. And if you really want to know why it exists, I'll probably do a much more advanced course on options where we talk about it. But you'll need to cross the beginner threshold first, right? So let me actually show you this other thing that we used to do as market makers. And I'll make a tool out of this at some point so that you guys can just play around with it. Excel theme, it's called how much over. Do you guys have any questions about this? I know this is kind of like have you guys heard about this put call parity? How many of you guys actually knew about this before? Chat. Anyone? No one? Do you guys get this? Like, are your minds blown the way my mind was blown when I first heard about this? That I can just, instead of buying a call, I can just buy a put and a future. Instead of selling a call, I can just sell a put and a future. Instead of buying a put, I can buy a call and sell a future. Like, it'll give me the exact same payoff. No, well, this arbitrage is not feasible for you. But now imagine this. Imagine this, right? Let me just do a new strategy. So where is this going to be interesting to you is, let's say, you had sold this. Let's say you had sold this market was at 23,000. Okay. Market was at 23,000 and you sold this call when market was at 23,000. At that time, it was quite liquid, right? Now the market has moved up quite a bit. This option is now worth 980 rupees, and it's going to be really illiquid, right? Because it's deep in the money. Actually, this is a better example because this is actually an illiquid option. It last traded 3 days before. So if 20th was the last trading day, Friday, it actually traded on Tuesday. So this is a really illiquid option. Okay. Now, let's say you had sold this particular option and now you want to buy it back, but it's so illiquid. You're going to have to pay a large bid-ask spread to actually cover it, right? So let's look at Nifty option chain bid-ask spread. देखते हैं इसका. ये है मेरा 22,950 Jan Paul. Look at this. 675 rupees, 1153 rupees. ठीक है, 500 रुपए का बिड आस्क स्प्रेड है यहाँ पे. तो तुमने बेची हुई थी ये कॉल, अब तुमको बाय करनी है, लेकिन तुम भैया इतना मोटा बिड आस्क स्प्रेड, एक्चुअली फेयर वैल्यू क्या है इसकी? Like you really want to pay this up, you put a market order, and market makers like me back in the day would have been very happy with this. Holy shit, like something that's probably worth 900 rupees I sold for 1100 rupees, right? So now if you want to cover this, the better way to cover this could be that instead of doing this deep in the money option, you could do this deep out of the money option instead. And let's say you had sold this, you can actually buy this future, and you are technically flat. You don't have to pay that massive bid ask spread, which is, in this case, it's a really high bid ask spread on the put side as well. It's a 72 rupee bid ask spread, but here it's a 400, 500 rupee bid ask spread, right? So to actually cut your loss out, you could, or even book your profit in case you had bought this particular call, right? You bought this call, but now you have to sell it and you have to sell it for 675. That's fucking stupid. You'd rather do it on the put and future side to actually lock in your profit, right? So that's where knowledge of this becomes interesting for us retail traders. Clear this out. Okay. Any questions? This is the last bit of put call parity. It's a very fundamental concept in option trading that price of calls, puts, and futures are intimately related. And I can replicate one with the other. No questions, and let's talk about realized volatility. I'll share my Excel. Okay, so I was just doing this. Ouch. So what I've done, guys, is you guys can see my Excel, right? Yep. Yep. Cool. So what I did is I just took the Nifty OHLC from 2012 daily OHLC, excuse me, from 2012 till November 4th, random date, but yeah, till November 4th. And then I just plotted Nifty. Okay, so this is what the returns of Nifty look like during this 12-year period. Done quite well. Then what I did is I I sort of like denoised Nifty. So yahan pe there is an obvious trend here, right? The trend is that the market has gone up, Nifty has gone up, but it's not been like a smooth ride, right? So this is a very smooth ride, but it wasn't really a smooth ride. There was a lot of noise around this smooth ride of sorts, right? So what is RV? What is realized volatility? So basically there is a smooth trend and then there is noise around it, right? So here there is a smooth trend and then there's a noise around it. So realized volatility is essentially that noise. It's essentially that wiggle, 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 wiggle. And so this is the decomposition, right? So इसको हटा के यहाँ लेके आए. So this plus this equals to this. This is my Nifty. Again, this is my Nifty. There is a trend and then there is noise around that trend. And that trend plus the noise gives me actual Nifty, right? Now, realized volatility pictorially is something like this. It represents itself in price space like this. It's the wiggliness is the volatility. And this is the relationship between this and the IV is what will eventually drive the profitability of an option trader, of a volatility trader. Now, how do we quantify it? That is, I've shown you sort of a pictorial representation of this. How do we quantify it is how many of you guys know what average तो पता होगा सबको. Mean पता है सबको क्या होता है? Mean of 4 numbers. Yep. Mean is just the average, right? So here I take the average. The average of these numbers that I've put randomly over here is 2.57. Okay. If you guys know what the average is, you guys know what the standard deviation is? Who doesn't know what the standard deviation is? Standard deviation, variance. Who doesn't know what that is? सबको पता? AS, you don't know. So, average पता है ना AS आपको? Now, yeah. So, ये मेरे numbers हैं. These are my original numbers that I observed. Yeah, let me try. These are the numbers that I observed. And then this is the average. Everybody knows the average. Now, the standard deviation is essentially telling me in just one number how far each of these numbers are from the average. So one way to quantify that is, chalo bhai, this mera number tha 1 minus, yeah, let me change this. ठीक है ना? Let's change this to numbers of सबके मैथ्स में बोर्ड एग्जाम में कितने आए थे क्लास 10 में. ठीक है, तो एक टॉपर था, उसके 97 आए थे. कोई बंदा था उसके 65 आए, कोई बंदा लुढ़क गया. किसी के 75 आए, एक बंदे के 85 आए, 73 आए किसी के, somebody got 69. ठीक है, तो ये एवरेज मेरा बन गया, लुढ़कना होता है 28. ठीक है, तो एवरेज है मेरा 70.28 and these were the marks of students in some exam. ठीक है. Now the average isn't really telling me what the spread was, like how far were people from the average, how far were how close were people to the average, how many people were near the average, how many people were far away from the average. And that is given by the standard deviation. So now let's see how much better this guy did than the average. This guy did a lot better than the average. Let's do this. Absolute value of this minus this. इसको हम कर देते हैं ठीक है. So this guy did he was very different from the average. This guy was closer to the average. This guy was very far away from the average. Closer to the average, somewhat farther to the average, and these two were quite close to the average, right? So the standard deviation is just essentially summarizing this into one number. That number is the standard deviation. Let's take the standard deviation. So this is my mean. So in the context of these are the marks that the student got, this is the average marks, and this is the standard deviation, right? So same thing here. Now, if this guy got a 1, for example, instead of 69, if this guy got a 1, my average will decrease, but my standard deviation will increase, right? So it went, average obviously decreased because this went from 69 to 1. And the standard deviation, which is how far away is everybody from my average. How far away is everybody? How much noise is there in the data set? If average is my signal, then this is my noise. This is my volatility, essentially, right? So all of a sudden, this entire series has become more volatile because these numbers are close together, and then this number is very far away, right? So, and this number increased because of that, because it's measuring how it's measuring with just one number. It's just one number that's trying to measure how far is everybody from the average. Let's change this back to 69. Now average increases and this number decreases. So, so the same, is that clear, guys? Like, does that make sense? Awesome. So, cool. So, now what is, now we know what standard deviation is. It's one number that tells us how far away are we from the average. Now let's go back to the stock universe. Let's go back to our Nifty. Okay. Nifty may, we have this thing which is the close price of Nifty. And when it comes to pricing options, we don't really care about the price of the underlying as much as we care about the returns. Okay, how much, what are the returns of Nifty, right? So here what I'm doing is I'm just calculating the daily return. How do we calculate the daily return of Nifty, guys? Does anyone know? अगर मैंने 100 रुपए में लिया माल, 101 में बेचा, तो मेरा कितना रिटर्न है? वन परसेंट रिटर्न, राइट? 100 में लिया, 101 में बेचा, 1% रिटर्न, एग्जैक्टली, राइट? 1 divided by 100, exactly. So 100 में लिया, 110 में बेचा, 10% है मेरा रिटर्न. उसको हम कैलकुलेट कैसे करते हैं? हम ऐसे करते हैं, दिस 110 डिवाइडेड बाय 100 -1, तो ये मेरा रिटर्न आ जाता है। अब मैं क्या कर रहा हूं, मैं डेली रिटर्न निकाल रहा हूं। तो एक्सेल में हूं मैं, मेरे पास ये क्लोजिंग प्राइस की टाइम सीरीज है, ठीक है, और मैं बस डेली रिटर्न निकाल रहा हूं। ये मैंने डेली रिटर्न निकाल दिया, रिटर्न इन पीरियड 2 डिवाइडेड बाय रिटर्न इन पीरियड 1 -1। अब इस रिटर्न की जब मैं स्टैंडर्ड डिविएशन निकालूंगा, अब एक एवरेज रिटर्न आता है मेरा, राइट। अगर मेरे पास ऑल दीज नंबर्स आई हैव व्हिच आर बेसिकली निफ्टी के डेली रिटर्न्स, राइट। अब इसका मैं जब व्हेन आई टेक द स्टैंडर्ड डिविएशन ऑफ दिस नंबर, this becomes a representation of my realized volatility. That is my RV. It essentially is telling me how much is Nifty going to wiggle away from its mean, away from its average return. If the average return of Nifty is, it's been what, 12% in the last 15 years or so, that is the average return, CAGR, राइट। बट इट्स नॉट बिन अ स्मूथ राइड। ऐसा नहीं है कि हर रोज उस 12% का जो डेली इक्विवेलेंट है, 12% इज द CAGR, क्यूमुलेटिव एनुअल ग्रोथ रेट, राइट। एनुअली निफ्टी ने 12% रिटर्न किया मेरे को, लेकिन एवरी डे मैं ये नहीं बोल सकता कि उसने मुझे 12% डिवाइडेड बाय 365 रिटर्न किया। अगर मैं बोलूं कि एवरी डे 12% इज एनुअल, देन ऑब्वियसली द डेली इज गोइंग टू बी 12% डिवाइडेड बाय 365, राइट। ऐसा नहीं है कि उसने मुझे एवरी डे इतना रिटर्न किया। Some days the return has been high, some days the return has been very negative also, right? But the average return is 12%, and the wiggliness around that 12%, the volatility around that 12% is given by the standard deviation of the return. And that is my realized volatility. ठीक है? So, and that is what drives my P&L when it comes to option trading, along with the implied volatility. Now, implied volatility. So let's actually go back to our Discord. Somebody had made a comment here. तो एक्सेल में कैसे निकालते हैं इसको, ये भी मैं तुम्हें दिखा देता हूँ फिर कंप्लीटनेस से। stdev.s वाला हम यूज करते हैं, एंड इसका अगर हम स्टैंडर्ड डिविएशन निकालेंगे तो मुझको बता रहा है कि डेली वॉलेटिलिटी जो है, बेसिकली मैंने डेली प्राइसेस यूज करी हैं, दिस इज द डेली क्लोज टू क्लोज प्राइस। सो इट्स सेइंग द डेली वॉलेटिलिटी इज 1.3%, एंड इसको हम एनुअलाइज करते हैं। देयर आर 252 ट्रेडिंग डेज इन द ईयर, राइट, समवेयर अराउंड 252 ट्रेडिंग डेज इन द ईयर। सो दिस इज जस्ट अ फॉर्मूला। बेसिकली मेरी डेली वॉलेटिलिटी को अगर मैं मल्टीप्लाई करता हूं स्क्वायर रूट ऑफ 252 से, तो मेरी एनुअलाइज्ड वॉलेटिलिटी आ जाए। दिस इज जस्ट अ फॉर्मूला, यू लाइक आई कैन शो यू हाउ टू डिराइव इट, बट व्हाट यू नीड टू अंडरस्टैंड इज जस्ट दिस कि यहां पे मैंने डेली प्राइसेस से डेली रिटर्न निकाला। डेली रिटर्न का फिर मैंने एक सबसेट लिया विच इज 23 डेज मैंने लिए, 25 माइनस, तो इन 23 डेज के डेली रिटर्न्स की मैंने स्टैंडर्ड डिविएशन निकाली, तो मुझको डेली स्टैंडर्ड डिविएशन मिल गया। उसको मैंने फिर इस फैक्टर से मल्टीप्लाई किया, तो बेसिकली मुझको एनुअल स्टैंडर्ड डिविएशन मिल गया। दिस इज माय एनुअल वॉलेटिलिटी, एनुअल रियलाइज्ड वॉलेटिलिटी, एनुअल हिस्टोरिकल वॉलेटिलिटी। माय आईवी जो मेरी इंप्लाइड वॉलेटिलिटी है, लास्ट सेशन में हमने बात करी थी ब्लैक शोल्स मॉडल के बारे में, एंड ब्लैक शोल्स मॉडल टेक्स इन अ वॉलेटिलिटी नंबर which is the implied which is a volatility, actually let's just call it volatility. And original idea behind black scholes was कि hey guys, you put in your volatility estimate कि how volatile do you think the underlying asset is going to be over the life of the option. You put in that estimate and you'll get a price. That was the idea behind the black scholes model. It said that, okay, once you know what the volatility is of the underlying asset over the life of the option until the option expires, from today until the option expires, how much is that underlying going to move? How much is that underlying going to wiggle? Whatever your estimate is, annualize that estimate. That's your annual volatility estimate. You plug that into the number and the price will come. But nobody ended up using the Black-Scholes model that way. What they ended up using it for was, okay, we don't know what that number is. We don't know how wiggly Nifty is going to be for the life of the option. We don't know. How volatile is it going to be? But we can observe the price because price is driven by demand supply. People are buying, people are selling. So there is a price. And based on that price, I can come up with a volatility number by backing it out from the Black-Scholes model, which is the IV. So IV essentially becomes the market's estimate, the market's consensus of what the volatility the market thinks is going to be over the life of the option. And that is precisely a point that someone had made in the Discord community. Let me share that as well, right? Just to bring it all together. So this is a heavy topic. It's not it's not something that's very simple. But you guys have invested time in learning what actually drives option prices, right? So this is Jitesh. You asked me if IV is high, option prices are bound to, or can they stay unexpectedly stable throughout? IV is basically future volatility and RV is actual volatility. This is a comment you made, right? So again, my answer was IV is the market consensus on future market volatility. The price at which demand and supply met of that particular option is implying a volatility. The buyer and the seller are agreeing, okay, this is what the price is, and the price is saying the price has a corresponding volatility attached to it, the implied volatility that comes from the Black-Scholes model. And that price is telling us how much it thinks the stock will move over the life of the option until expiration, right? And that is implied volatility. So the implied volatility is trying to predict what the realized volatility is going to be over the life of the option. But we don't know what the realized volatility is going to be, right? We don't know because it's in the future. Just how we know that we don't know what the future stock price is going to be. We don't know what the future volatility is going to be, right? So read this again, guys. IV is the market consensus on future market volatility, i.e. the market is telling us how much it thinks the stock will move over the life of the option. That is implied volatility. If the volatility being implied, it is the volatility being implied by the market. The market can be right or wrong about this, but that is essentially what it is saying. It is the market's prediction of what it thinks the future realized volatility is going to be. And what is realized volatility, guys? It is the standard deviation of Nifty's returns, right? I'm gonna stop here. I'm gonna pause here. I'm gonna ask you guys any questions. Yeah, absolutely, Om. So Om said need to put all this together to understand how to trade this, right? So let me actually let's go back to the strategy builder. So now that we know, guys, that we know what IV is, we know what RV is, and we can see over here when we are looking at our trading, this is RV. I'm putting RV over here. You guys know what RV now is. The more Nifty whips around, the more the realized volatility is. The the calmer Nifty stays, the lower realized volatility is going to be, right? So when IV and RV are approximately the same, you're going to break even. Oops. Just trying to make these match. This is. अरे बेचा हुआ है. I'm an idiot. One sec. Like some kind of a mismatch over here. There's like a little bug or something. I don't know. Could be the weekend also. Weekend effect भी हो सकता है. Quite possible it's the weekend effect. Anyway, so back to how do we actually trade this, right? How do we actually think about trading this? So one interesting phenomena that exists in the market, actually scratch that. We know that our PNL is driven by these two magic numbers, IV and RV, right? We sold a straddle at a 14.2 IV. If RV is 13, we're going to make money. If RV is 15, we're going to lose money. We all understand that concept. We know what IV is now. IV is just a number that comes out when we look at the price of the option, and then we use the Black-Scholes model to back out what the market thinks the volatility is going to be over the life of the option, right? That's the market's consensus. And we know what the realized volatility is. The realized volatility depends on how much Nifty actually whips around. It's a representation of the standard deviation of the returns of Nifty. Now, all the pieces are now built. So let me show you a plot of RV over time. And then let me show you a plot of IV over the last 7-8 years, जितने भी time का data है मेरे पास. Give me a sec, guys. Just opening up the relevant Excel file for that. यही वाली दिखा देते हैं. यही वाली दिखा देते हैं. Okay, so this RV21 is essentially, let me plot this. Insert chart line. So notice, guys, this is the 30 calendar days or 21 trading days roughly की realized volatility. Okay, so I've plotted this realized volatility. These are the standard deviations, annualized standard deviations. And do you guys see a pattern here? Is there a pattern you guys see here? So the pattern that I'm looking for here is that it kind of, for most of its history, it stays. So let's look at this left part, right? Left part में यहाँ before, so this is of course, this is the COVID crash, okay, where volatility went crazy. Prior to the COVID crash, what you see is that there is a sort of general level, and then there are periodic spikes. Spike आई, gira, but it's essentially like a straight line with like things moving up and down, right? Like slight. Sorry. So whenever there is a crazy market event, volatility spikes, realized volatility spikes. In other places, whenever there is some kind of a crazy move in the market, not as crazy as COVID, essentially what you see is whenever there is a new market event, there is a spike in volatility, in realized volatility. Now, let me also plot implied volatilities. This was the 21-day RV. Now, let me plot the 30-day IV, which is essentially the same thing. Peak was absolutely in COVID, Jitesh. So let's plot this also. Insert chart line. दोनों को सेम उस पे ले आते हैं. So now this is the realized volatility. Sorry, this above is the realized volatility. Whoops. So क्या हुआ? So above is the realized volatility. Below is the implied volatility. ठीक है? So they kind of move hand in hand. Implied volatility is the prediction. Realized volatility is what actually happens. Sometimes in this case, in the case of COVID, realized volatility increased and then IV matched it. In other places, IV tends to be a decent predictor for realized volatility. But once you, and this is sort of building into the next lesson, that once you actually look at both of them together, IV and RV, once you look at both these guys together, and I2 minus M2. तो यहाँ पे मैंने क्या किया? Remove this. तो column O में मैंने क्या किया? Because guys, my PNL of course depends on IV and RV, right? However much IV and RV deviate, that is what drives my PNL, right? If IV is much lower than RV, then buying options makes money. If IV is much higher than RV, then selling options makes money. So what I did is I was like, okay, let me just look at the historical relationship of IV and RV. I visualized it in a chart. I just showed you the chart. They both look quite similar. But then I was like, okay, let me just subtract one from the other, right? Let me subtract RV minus IV. And then let me just plot this guy. Okay, this is IV minus RV over the life of the option. Every data point is essentially उस टाइम पे IV क्या था and उसके 21 दिन के बाद RV क्या निकला. Basically, I'm saying कि how good of a predictor is IV. यहाँ पे मेरा है IV and यहाँ पे है मेरा उन 30 days के बाद actual RV क्या निकला, right? IV is my predictor, RV is what actually happened. And I'm just checking to see how good of a predictor is my IV. Is it a good predictor or a bad predictor of what happened in the future? Because IV, like we said, is the market's consensus. It's the market's prediction of what will happen in the future. Right? How good is the market at predicting this? So I took the difference between IV and RV. And now let's plot this guy. अबे एंड में क्या हो गया? तो प्लॉट ही फट गया मेरा. लास्ट वैल्यू से फट गया क्या? क्या दिख रही है लास्ट वैल्यू? This is not showing me anything at all actually. One sec. ये वैल्यू कहाँ से आ गई भाई? वेयर इज दिस वैल्यू कमिंग फ्रॉम? 1564। और भी नीचे, अच्छा यहाँ से आ रही है भाई। माय बैड, आई plotted the entire thing. I shouldn't have plotted the entire thing. Delete this again and let me plot it again properly. यहाँ तक insert chart line. So now this is my IV minus RV. ठीक है। अब इसमें the interesting thing is guys, most of the times this value is greater than 0. Of course, this is a really big, large negative value, but this is, I'm plotting IV minus RV guys. And what you'll see is that most of the times this is greater than 0. So most of the times IV is greater than RV over the life of the option. Okay. So, and you'll see this here as well as we, let me look at the average of this. Average is 7.48. So on average, in the last 7 years, IV has been more than RV by 7.48. Actually not 7.48, by 2.14. So by 2.14 points, IV has been greater than RV on average. If IV is greater than RV, तो क्या trade डाल सकते हैं हम guys? How can we make money if IV is greater than RV? Yep, that's right, Om. That's right. So this difference between IV and RV is what is called the volatility risk premium. This volatility risk premium essentially says that options, when you look at volatility space, tend to be a little expensive than what their implied, than what their realized volatility should imply. Okay. And because of this volatility risk premium, there are dislocations that exist in the market. One very simple trade that you can put on is just this. You know what? I'll just always sell options. If I sell options, I will be able to capture this volatility risk premium provided I don't blow out, provided I can manage my risk. Okay. So what I've done today is, guys, I showed you guys put call parity, and next lesson we'll talk about VRP in more detail. Okay. What this volatility risk premium actually means. So this course is sort of like, a beginner's, it started off as an experiment. Thanks for being part of this experiment with me. The idea behind this course was, how can I sort of expose volatility trading? And course is not over right now. By the way, guys, there's a lot more. Abhi aadha course hua hai, I would probably say. Like there's a few more sessions where we'll go over this VRP. Maybe we'll put some trades on. Maybe we'll do one session during market hours also, where I'll put on a trade. New Year's, man, let's put a trade on. So the idea behind this course is to expose you guys to what volatility trading actually means. This is how most professional option traders trade. They look at volatility, they look at IV, they look at RV, and then they place trades. There is a phenomenon that exists in the market which is known as the volatility risk premium, the VRP, that says that, hey, markets on average tend to price options as more expensive. It's not theta, it's the VRP, it's the volatility risk premium. People say theta is an edge. Theta is not the edge. The edge is actually the difference between IV and RV. That is what is driving your PNL. And so today we talked about put call parity, which is a fundamental relationship between calls, puts, and the underlying, the prices. Okay. And then I gave you guys an intro to what realized volatility actually means. I hope I try to keep, like I didn't show you a formula also for realized volatility, right? I just used Excel and I just showed you numbers and I gave you an example of what does standard deviation actually mean. That is what drives my PNL at the end of the day. The how much is Nifty actually going to move? I don't care if it's going to go up or it's going to go down. I just care how much it's going to move. Up and down both mean the same thing to me from an options perspective. Okay. So we talked about realized volatility. You guys have an idea now of what RV actually means. The relationship between IV and RV. IV is just a prediction. No, what most tools will give you RV. We're actually just working on a tool right now. So you already paid money for use of the software, right? Yes. So you have credits. We're coming up with a tool right now that will show you what the RV looks like in the market, and then you can take a look at IV, you can take a look at historical RV, and then decide whether you want to buy or sell options, right? What I'm saying is, on average, IV is greater than RV, so you can make that assumption. Yahan pe, what I've done is, I'll show you another data point, right? So what I've done is I've essentially broken the historical implied volatility numbers into 10 sort of deciles, right? This is the first decile where IV was really low, between 8 and 10, then 10 and 11, 11 and 12, 12 and 13. Oops. Right. And then what I've done is, for IV being in these levels, I've essentially asked what is the average VRP. VRP is what difference between IV and RV. So on average, how expensive are the options when IV is in this range, when IV is in this range, when IV is in this range, right? And you'll see that in volatility terms, this is on average how expensive these options are. This is kind of like a back test, but it's in volatility space, right? यहाँ पे ये भी बता रहा है कि भाई अगर IV between 11 and 12 है, तो RV tends to be higher than IV if I look at the historical data, right? So, but on average, what we are seeing is that on average, IV is greater than RV. Why this is the case, we'll go into it next lesson. We'll talk about VRP. What does VRP actually mean? Why does it exist? And how can someone actually capture it? Okay? So AS, you don't, let me just answer that. So AS asks, do we need to calculate RV? So, I would suggest, guys, we are looking at options pretty deeply now. We are all here to understand. I'll tell you how I think about markets, right? I always think about markets from a question of why and how. Like, why did this happen? Why did this happen? Why? And you just keep asking why, right? If you want to be successful in the market, you need to have that sort of investigative nature, research mindset, and you need to be at least, you need to get your hands dirty with Excel at least. I'm not asking you to code. We made a tool which is a no-code backtesting tool, no code. But the purpose of this course is to go a little bit deeper. If you want to go a little bit deeper, you need to get your hands dirty. And I would say, you don't need to, this is not like, there's no final exam here, right? Do we need to calculate RV? Aapne pucha. There's no final exam. Nothing is out of syllabus. Nothing is inside syllabus. I am just showing you how vol traders think about the market, and are there any trades to be put on when you look at the markets from a volatility lens, right? So you don't need to calculate RV, but you need to, and we'll give you a tool that calculates it for you. But will it help you in your future trading, in your future thinking about the markets, in your future thinking about options trading, if you know how to calculate RV and you can just, download Nifty close prices from Bhav Copy, from NSE's website, and then just quickly see कि भाई RV क्या चल रहा है. Yes, it will be beneficial to you, right? So maybe my homework for this for next week, the homework should be कि boss Nifty की prices कहीं से download करो, close prices, and calculate the annualized realized volatility based on daily prices. The way I've done on this Excel. Let me share this Excel. इसका क्या नाम है Excel का? Excel का नाम है Nifty 1. Nifty 1. Just use close price, man. I use close price. So what you'll see is that the RV won't really itni different nahi hoegi if you use open prices, low prices, high prices, or close price. Just use close prices. And that's one of the interesting things, like prices move quite a bit, but volatility is a slower moving parameter. That's what we discussed last time as well, right? It's slower moving, so it's easy to predict. So yeah, that would be a cool homework. Agar nahi aati, if you can't figure it out, don't worry about it. Maybe I'll do a live demo of it in the next session कि जल्दी से RV कैसे calculate करनी है. But Google करो, take a look at the formula. It's just the standard deviation. You're using daily prices, so remember you're going to need to multiply it by that annualizing factor, which is the square root of 252. If you want to know why, you can ask ChatGPT why you're using, but that's a mathematical technicality. But the more questions you ask, the more research you do, the better you'll be at understanding what the hell is actually happening in the market. In the case of option prices specifically, right? So that's the lesson today, guys. Share your feedback also, guys. I'm trying to keep make options trading from a volatility lens as simple as possible, as intuitive as possible. Not trying to do a lot of math. So please share the feedback with me also. अभी तक क्या समझ में आया? This is lesson number 3, right? Lesson 1 was about edge, bet sizing. Lesson 2 was about IV. Lesson 3 is RV, realized volatility. Lesson 4 is going to be VRP and what kind of trades can we actually put on to capture this VRP. Then we'll look at the risks associated with trying to capture this VRP. Just because IV is greater than RV on average doesn't mean that it doesn't come with risk, come without risk, right? VRP ka full form hai volatility risk premium. You're taking that extra amount of volatility risk for which you are getting that premium, which is the amount that IV is greater than RV, right? So we'll talk about risk and then, yeah, I guess that'll be the end of it. How do I put this trade on and how do I manage risk? What does getting lucky look like? What does getting unlucky look like? That'll be the idea of this course. All right, guys. Any questions? No questions? थोड़ा heavy topic था क्या? Regarding signal trading, yaar, I'm not, Ramneet is the guy for that. Yeah, Jitesh, it's great how you're getting these ideas, right? Plot both of them together, IV crosses RV, Becho. It opens a new world for you, right? Like, how do I think about the markets? How do I think about options trading? And you're not the first one to think of this concept. This is the correct way to trade options, where you're looking at volatility. All option trading is volatility trading. Whether you acknowledge it or not, it is. Your PNL is driven by volatility. It's not driven by market going up or market going down. It's about how volatile is the market. And the sooner we understand that, the sooner we start thinking about it from that perspective, the more informed traders we become. ठीक है, चलो guys, hopping off. So next session also we're going to do on Sunday, guys. Just because I have an exam on Friday, so I don't think I'm going to get time to prepare for the VRP lesson by Friday. So we'll do it. On Sunday only. ठीक है? All right. See you guys. Bye.